Every cycle has its winners and losers. People are suggesting it's still possible that we may be able to slow down the economy and rein in inflation without tipping too many people over the edge. And that's what you have to hope for.
Gemma Dale, welcome to Property Insights.
Thank you so much for having me.
You are from NAB Trade, which, as I understand, it's like ComSec sort of thing, you know?
Better. Exactly like ComSec, but
I expect you to say that. So you look at all asset classes.
Yeah.
NAB Trade, is a organisation which you do a podcast too, don't you?
I do, yes.
Yeah. What's your podcast called?
It's called Your Wealth.
Your
and
Wealth.
It is about helping people invest and helping them make good decisions with investing across whatever it happens to be that is your field and what you're most interested in. So it's about helping people create wealth.
Which could be equities, share market, it could be in property, real estate, etc. And there are a number of other asset classes, I guess, that sort of exist. Cryptocurrencies, for example, could be one of them. Today, this is called Property Insights. I want to talk to you about the property market. But I probably want to talk to you more fundamentally about, well, what the hell's going on out there at a macro level. So we keep getting hit up about inflation. We keep getting told that unemployment's fantastic in the country. There seems to be a disconnect because we're also getting told there's a potential recession coming. Can you make some sense of that stuff for me?
It's complicated, isn't it? It takes me back to university, and I feel like everything I learned in economics at university hasn't really been very relevant for the last decade or more, when we've had insanely low interest rates, like record insanely, basically zero interest rates.
Say 6 months ago.
6 months ago. Most things don't make a lot of sense. You don't worry about inflation. We still had record low inflation. We had record low unemployment. All these things that weren't supposed to happen concurrently happened concurrently. So we had very high asset prices, very low interest rates, very low unemployment, economies really performing very strongly, all things considered. But the economy works in a cycle, and so do asset prices, and that comes to an end when prices start to get out of hand. And most of us haven't had any recent experience of that. Inflation's been really low for a long time, but it's rising really fast. If you've bought anything in the last couple of years that has a variable price, you know that, right? You know it at the supermarket, you know it if you have to buy a car, you know it if you're thinking about houses, for example, or you're doing a renovation. All of those prices have gone through the roof. And suddenly the central banks go, well, we can't keep rates super low anymore. We have to start raising rates. Everyone's got a ton of debt. And when you start raising rates, suddenly people have much less money to spend because they're spending more on petrol, they're spending more on their mortgages. The economy starts to slow down because the consumer is not spending as much. And then suddenly we have this fear of recession that we're going to slow things down so much that it's all going to fall off a cliff.
Why is inflation, it's just a number. Why is it such a problem for governments and reserve banks and central banks around the world and whoever else sort of gets worried about this sort of stuff? And why are the media sort of so focused on it?
Obsessed?
Obsessed is probably a good word. And it makes everyone scared, terrifies everybody.
Yeah. I think it's worth remembering interest rates at this level is unheard of in a historical context, right? So they have been at emergency levels when the economy has not been in an emergency state. It was obviously during COVID. Inflation, we say it erodes your purchasing power, which is a really unhelpful term, right? It doesn't mean much. But if you have $1,000 a week to spend to feed your family and fill your car and pay your mortgage and spend, right? And you used to have $500 of that for discretionary spending to go out to dinner or to go to the movies or do any of the things that you do.
Or to save.
Or to save, exactly, or invest. A little bit of that is gone now because your grocery bill used to be $250 a week. Now it's $300 because it costs $11 for lettuce and all those sorts of things. And your fuel bill, which used to be $100, is now $150. And your tolls, if you live in Sydney, your tolls are suddenly $40 or $50 a week if you do a lot of driving. And if you have childcare expenses, if you have those, you know inflation really, really well. All of those costs are going up. Your healthcare insurance, all of those things go up. So the $500 that you used to be able to spend on discretionary purchases is now $400 or $300, and you're not saving as much, you're not investing as much, and you're not spending as much on fun stuff. So you can see how suddenly money gets sucked out of the fun stuff and everyone goes back to just focusing on the essentials because suddenly that starts to matter a lot more. It's much more expensive than it used to be.
So if they put my interest rate up, the Reserve Bank puts its interest rate up, then all the lenders put their interest rates up too because money costs them more, which means me, the consumer, I'm going to have even less money.
Yes.
On the example you just gave, well, what is the general reaction and or behaviour of the consumer? So do they just sort of put their hands in their pocket and say, I'm not going to spend any more money, or do they go and get another job, or do they come out of being a mother at home if they maybe just had a child 6 months ago, a year ago, and go back to work?
So in Australia, it's worth remembering that the worst thing that can happen to you is to lose your home. So people are absolutely determined not to find themselves in a scenario where their home can be repossessed. And they will do all the things that you mentioned if they can to avoid it. The first thing you do is cut back on your discretionary spending. You cut back on the non-essentials, the travel and the fun stuff, and you batten down the hatches financially. But you may have to go and get a second job. You may have to borrow from your parents, for example. Some people have been in that situation. People will do whatever it takes to keep their homes. And so for people with mortgages, rising rates and financial stress, they hurt really badly, but they will make a lot of sacrifices to avoid having to leave that family home.
I know it's not a good idea for anyone to be critical of the Reserve Bank. Although I did hear the ex-head of Treasury, Ken Henry, more recently having not a crack, but sort of saying that the Reserve Bank might have got it wrong. Do you think it's fair that when inflation is doing what it's doing at the moment, that the people who bear the brunt of repairing the inflationary spike are people who borrowed money to buy, say, a house, or borrowed money to run a business?
It's a really, really hard one. I will say that markets have been quietly suggesting that the Reserve Bank was wrong for a while. They've been pricing in much higher interest rates for a long time. They were way ahead of the RBA. But that's true of global banks as well. That's not just the RBA. In the US, the Federal Reserve was saying that inflation was transitory, and it clearly wasn't, and markets knew that rates would have to rise. It's true in every cycle that it's the last borrower who ends up paying the price.
Pass the parcel.
It's past the parcel, and it's tough. There isn't a prize at the end, right? It's really unpleasant, and it's so hard for people. In every cycle, it's those who had to borrow the most at the end to pay the most for property prices usually, but other asset classes as well, who will wear the greatest cost, and that's really difficult. There will be retirees watching and listening to this who say they've paid the price for the last 10 years because their cash has earned them nothing in the bank.
That's true.
So every cycle has its winners and losers. The challenge is how the RBA gets us through this. If they can engineer a soft landing, it's a challenge. People are suggesting it's still possible that we may be able to slow down the economy and rein in inflation without tipping too many people over the edge. And that's what you have to hope for.
Globally, investors love Australian mortgages because they just outperform every other mortgage in the world, and they have done for the last 30 years. Our arrears and delinquency rates in Australia relative to the rest of the world are like dream time. It's so good. We are so good at protecting our mortgages as individuals relative to the rest of the world. And that's got a lot to do with our psyche about, this is my home, I've got to protect it no matter what. And this has been sort of delivered to us from our parents, from our grandparents. But over the last few years, we've got a cohort of people in this country, say from 20 to 30, who have probably taken the position that they're never going to be able to afford a home. Is this an opportunity perhaps that all those doomers, not the boomers, but the doomers, who felt as though they're never going to get into the housing cycle, never going to buy a property, and basically therefore have dismissed it? Do you think this is an entry point for those individuals? And what would you be saying to them? Should they be paying attention and maybe starting to save a deposit?
I hope that challenge for young people changes, right? It's not equitable. It's not fair. The ultra low rates that we've had have led to what they call an everything bubble globally. And it has meant that those who own assets have become far wealthier, and those who didn't own assets, who are usually young people, have become less wealthy on a relative basis. And you need to remedy that over the long term, right? That's not okay. No one wants their grandchildren to be much poorer than they were at the same age. That's not cool. So we do want to see it change. I think it's perhaps a bit early if you're a young person to jump into the property market. In Sydney, you're only talking prices off a few percent. It's not like they're down 20 or 30.
It's been like 1%, 1.5% a month or something like that, along those lines.
It's pretty marginal at this point. And given they jumped 30% in 18 months, that's not enough to make you suddenly super wealthy relative to the next buyer. So it's a great time, I think, to start saving and thinking about this as part of your future. You don't need to rush in. And that's a good thing, right? FOMO's terrible in the property market. It's dreadful. That's when people massively overpay, particularly at auction. You do have time on your hands as rates rise. You've got plenty of time to watch how this play out. And you can save during that period. As rates rise, you also get more on your interest. So you can put some money in the bank, put some money aside, start saving, keep looking around, see if you find a bargain. It'd be wonderful.
So when I was 20... the first thing you did when you turned 20 or you graduated from university, you might have got a job, which in my case happened. And the first thing I did was I bought a property, much cheaper in those days. And is it a matter of the 20 to 30-year-old cohort of people today have simply parked the idea of buying it in their 20s and perhaps will end up buying it in their 30s and 40s. They're just going to be later in the cycle, just like they get married later, just like they have kids later. Is it just a simple matter of transferring these acquisitions and getting into the property cycle to another period in your life when you're earning more money? Perhaps you've got a partner who can help you borrow the money to buy the property. It might be a period where you're thinking of settling down, so you think you need to have the security of a property. Whereas when you're 20s, it's a little bit more fluid. And is that something that you have experienced? Do you think that's part of the solution? In other words, don't rush out there and buy something. Just hang.
I think we hope that's true. Once you're in your late 30s, particularly if you have children, one of you is working part-time, your expenses really grow with childcare and so on. It's really difficult to accumulate a deposit during that period if you haven't accrued a deposit before. And that's what's getting really hard. If you weren't saving during your 20s and 30s, then to be able to buy something in your 40s is going to get hard. If you spent that time saving and investing and you've been building up some wealth in some capacity, whether it's in shares or in something else, and you have that to invest and put down as a deposit, fantastic, right? You're well set. If you spent that time having lots of fun and not been saving, it's going to be much more difficult for you. There's a lot of other people who have also been hoping for an opportunity to buy a property at some point. So it's still a competitive market, but we do hope everyone has the opportunity to live somewhere secure, right? We don't want a housing crisis in this country.
So what you're sort of saying to me then is that for those people in that 20 to 30 range, it's one thing to accept that you're not going to buy a property perhaps in that 20 to 30 year period, in that 10-year period over 20 to 30, but it doesn't mean you can go and spend everything you earn. You've got to start saving and perhaps investing in various marketplaces in order to build those savings at a faster rate than you would otherwise get if you're getting deposit interest at a bank. But take the stress away from yourself, take the pressure off your shoulders and stop thinking, why haven't I got a property? Because mum and dad have been telling me I should have bought a property when I was 25 or 26. Take the pressure off, but at the same time, have a strategy to build some, let's call it wealth or a deposit by investing in other asset classes. And by the way, these days it could be just putting the money in the bank because soon you're going to be getting a really good interest rate. Yeah. 3 months ago, you wouldn't even think about it.
100%. It is a wonderful time to go, I might be able to just build up a deposit over 3 or 4 years and be able to do this in a few years' time. And people have not felt that way for the last 18 months, maybe the last 10 years, right? It's been a tough time for young people, but it is changing. We're not going to see, always have to be careful saying we're not going to see, but we probably won't see another 30% jump in house prices in 2 years, right? That's not going to happen. That would be highly unlikely. It's a good time to save. It's a great time to invest and think about building a sort of secure base for yourself when you do want to go out and do it. And as you say, you don't have to rush into it. I bought my first property when I was 28 and I was single at the time and I could afford to. It was a stretch, but I could afford to. But it was 28, it wasn't 20.
And I haven't heard someone say that for a long time. It's a good time to save. You see, 6 months ago before the cycle commenced and before we started looking at the inflation bogey, if you put your money in the bank on deposit, you might have got 0.1% per annum, which means after you take inflation out, you're actually losing money. So it wasn't a good time to save. If you put the money in the bank, you're just parking your money there. Now, though, as inflation rises and interest rates go up, deposit rates will go up. It's actually a good time to save. It actually is a good time to save. It's a good time to accept a return from the banks, an interest rate for a change. And again, if you're patient enough about it as a younger person and you are prepared to save for 5 years or 6 years or 7 years, you will get your deposit. And what's also good about this period, I like your comment on this, is it seems as though we're moving into, and I don't know how long we'll stay there, but we're moving into a period where wages will rise because unemployment is so low. You would expect that wages could rise. So it's a good time to save. It's a good time to stay in my job or move jobs for a better salary or wage. And hopefully that bigger wage will allow you to qualify as a borrower as well as having a deposit. Is that something is that a prognosis you see with this inflation period that we're sort of currently experiencing?
Yeah, I think that's absolutely right. The other thing I would add is people see it as something that should get a return and it hasn't for a long time. But remember, it's a great hedge. When everything else loses value, cash is still cash. Your $1 is still worth $1. It may be worth 98 cents because of inflation, but if equities have fallen 20%, which they have in the US, and property is falling also, and the challenge with property is when it falls, it's from a much higher base for most people. So your $1 million, when it loses 2%, that's still very meaningful to you.
Totally.
That cash is still cash, right? It's still sitting there. What cash gives you is choices. And I think for so many young people, having that cash sitting there, if everything goes to pieces and you have cash, you have choices. You may be the person who picks up a bargain apartment in this environment when someone who didn't save during this period wouldn't be able to. I think also your point about the employment market's really interesting. As a young person, your greatest asset is your time and your skill set. You can go out and do amazing things in this environment. The young people I'm talking to, they're getting 10 job offers a week. They're getting tracked down by recruiters on LinkedIn. Like, it's quite amazing how hot the employment market is for young people with skills. That's exciting, right? We haven't seen that in a long time, particularly during COVID. Take advantage of it.
I'll just ask you one final question, Gemma. And I'm sure you're still young enough, definitely young enough to be able to answer this one. Take yourself back to Gemma at 25 years of age, knowing what you know, have accumulated in terms of knowledge today, and knowing what the market presents today. What would you say to your younger self about the property market?
About the property market, take a chance. And don't wait for someone to join you. Go out and do it on your own.
In other words, don't wait to get married or get a partner or whatever.
You can do it on your own, which was true for me at that time. And I know it's much harder for young people now, but it was true for me at that time. And thank God, right? Because if I'd waited, I would have waited till I was in my 30s. And it would have been much, much harder. So time is on your side when you're 25.
Gemma, thanks very much. That was awesome.
Thank you so much.